Hey, what's up, everyone? Welcome to a new year, 2026, a new year of the Wealth Webinar Weekly Series. This is the show we do each and every single Wednesday, 1 p.m. Eastern, called Wealth Webinar, where we dive in deep on different topics like the infinite banking concept, becoming your own banker, real estate investing, private money lending. We'll talk about the economy. We'll talk about tax strategy. We'll talk about different opportunities. But this is the place to be each and every single Wednesday to learn about, at the end of the day, how to take back control of your money and solve your money problem. And that's exactly what myself and Craig Yeti are going to be getting into today. So for those of you that are new here, my name's Stephen Nagy, business partners and friends with Chris Naugle. Now, Chris is usually on Wealth Webinar. However, today he is flying home from British Columbia. He was out in the western part of Canada, snowboarding with a couple ex-professional snowboarders, talking business, talking investments, talking partnerships, and making things happen for the entire community. So we look forward to having Chris back tomorrow, and he'll be here next week on Wealth Webinar. But for today, myself and Craig Yenny will be hosting the show. So for those of you that are new, been working with Chris since 2019. I've been in the financial education space really since I came out of college as a personal financial advisor, fully licensed with Ameriprise Financial. Did that for a couple of years. Realized traditional ways of looking at money and investing in retirement didn't make all the sense in the world to me. Plus, we were leading up to 2008 when things were about to hit the fan. Luckily, I was able to pivot into real estate and entrepreneurship. Have been doing that ever since. So for the past, I don't know, almost 20 years now, been in this space. Absolutely love it. And all we do each and every single day is we learn, and share. We learn new strategies for controlling your money, for investing, for building wealth, better ways of doing things. We go out there, we test this stuff, and then we bring it to you and we share it. And this is what we do here at BYOB Money School, and really looking forward to what we have ready to go for you here today. Now, before we get started, I'll introduce Craig Yenny. Craig is somebody that we refer to as the freak in the sheets, but in the means of spreadsheets. Craig is a genius when it comes to numbers and being able to really visually portray and prove out all the stuff that Chris and I like to talk about. Craig actually puts it into a form that he can actually show you and prove it out to you using math, using science, using technology. So, Craig, I'll let you do a quick little introduction and we'll dive into this.
Yeah, thanks, Stephen. And, just a little background, as Stephen mentioned, I'm kind of the analytical of the team. Spent 31 years in an engineering kind of career and retired from that a few years ago. And for those of you that know Nelson Nash, he's the one that kind of codified the whole infinite banking concepts process. And Nelson Nash always talked about how we should be in two businesses. The one business is the one that you make your income from that, feeds you and gives you a place to live and all those things. The other business we should all be in is the banking business. And that's what I did. I started my first banking system about 17 years ago. And what you're going to hear from this team is these are strategies that we've used. We've used them for a long time, and we know beyond a shadow of a doubt that they work. And now we're out there teaching and proving and sharing. So anyway, that's kind of the path I took. Is I was in a different career doing infinite banking, using alternative strategies, and now I'm just joined the team. I love working with this team and sharing what I've been able to do, and hopefully that helps others. Whether we're getting out of debt, whether we're helping to show you how to purchase major items like cars, pay for college. And then the last real big pillar we work with that Stephen mentioned is opportunities and private money and building more cash flow, building more money into our banking system. So those are the premises of what we do, and I'm glad to be here. Glad to see everyone here as we kick off 2026 Wealth Webinar.
Yeah, good stuff, man. And since it is a brand new year, I just wanted to give one really, really huge shout out and thank you to all of you that are on this show each and every single week. Those of you that join our weekly webinars on a regular basis, you attend our virtual events, you show up at our live events we do each year. It's great to have all of you. And a lot of you started as clients and have become friends. And without you guys, we wouldn't be able to do what we do each and every single day. So we appreciate that. And you have allowed us to become the number one infinite banking agency in the country for what we do. And it allows us to go out there and continue to take that foundation that Nelson Nash, Craig, I know you just mentioned Nelson Nash. And for those of you that don't know, our Nelson Nash is kind of what we consider, what do you say, Craig, like the godfather almost, like the founding father almost of the infinite banking concept. Would that be fair to say?
Yeah, it would. I always kind of listed as he's the one that codified the whole process because it is something that if you're watching that video that Stephen was playing earlier, Chris was talking about, this has been going on for a long time. But Nelson Nash is the one that really brought it to the mainstream and brought it to everybody that, you buy a car, you can use this process. You have debts, you can use this process. You're doing investments, you can use this process. So I would really say Nelson Nash was the one that brought it to the mainstream, codified it, put into a process that we can all consume and understand it.
Yeah, well, yeah. Without what he brought to the world, we would probably not be here talking about what we're talking about today. But we've been able to do what he does and take that into the new world of AI, into the new world of technology. And we're innovating right now. We're building right now. We're going to show you some of that here today with the BYOB Vault and what we've been able to create and continue to develop. So again, thank you for all of you that have been with us now over the last year, over the last 2, 3, 4, 5 years now, as we continue to grow and stay the number one infinite banking provider in the United States of America. So appreciate all of you. Those of you that are new here, thank you for being here. I just want to say one thing, infinite banking, becoming your own banker, what we teach about taking control of your money. It's not a, let me learn it and implement it and I'm done. This is a lifelong lesson. This is something that's always changing. That's always something new. There's always a new way to use it. Infinite banking, there's literally an infinite way to use these policies, to look at these policies. And that's exactly what we do. And that's why we continue to put out new education. We do 6 live webinars every single week. You can hop on those. They're completely free of charge. Every single one of those each week is new content, new education, new strategies. We also do virtual events that you can buy tickets for. We do live events where you can come meet us in person and learn from other experts across the country. And we'd invite you all to continue to attend these webinars, attend these events, and continue learning and educating yourselves for a lifetime. And that's exactly what we're going to talk about today. We're going to talk about, what infinite banking really is and how you have to give up a little bit to get ahead, but why and how it rewards long-term thinkers. Is that fair to say, Craig?
I think that's spot on. It's all about I think the people that are successful with this process are those that are willing to think long range, think long term, not a get rich quick scheme. It's a way to keep and control wealth in your family for the rest of your life. And if
Yeah.
if that fits in with your methodology, then you're in the right place here.
Yeah, and I could give just a quick example of kind of what this looks like, and we'll talk about some of the specifics. Again, we have on the YouTube channel at the Chris Naugle, you can go watch the full infinite banking presentation, which goes right from the very beginning of it all, of the mindset and kind of comparing against traditional ways of looking at investing and saving money, traditional ways of financing things through the banks, the mindset of that, and it walks you right through this. This presentation walks you right through the different use cases of infinite banking and specifically how it works and what it looks like. That's not what today is. Again, these wealth webinars are different each and every single week. So if you want that foundation, we'll put the link on there. You can watch that video. Today, we'll talk a little bit about the basics, but we're going to start getting into actual use cases and actually real people that are using this, showing you real world examples. So let me just start with one of those. I mean, have any of you, I don't know, purchased anything in the last 6 months to a year, let's just say for $10,000. And I'll give you an example myself. We just bought a couple of years ago a new golf cart. Okay. With the community I live in here in South Florida, it's a smaller community. A lot of people drive golf carts around, things like that. Well, they had a crackdown, said your golf carts need to be street legal and have a license plate and all that. So I was like, all right, well, let me upgrade my 1991 club car, one of those old traditional ones. I love the thing. It was awesome. Ran great, but it wasn't street legal. So I needed to upgrade. So we started looking at carts and I found one, let's just say $10,000. So typically what somebody would do if they wanted to purchase a $10,000, and I'll ask, has anybody spent around $10,000 on any type of purchase, I don't know, in the last year, in that range. And so you can think about this yourselves. But for me, it was this golf cart. So if I was traditionally looking at it, I could look at it two different ways, really. And you can think about this with buying cars too. So I could go out there and I could get money out of my checking or savings account, and I could buy that golf cart for cash. Now, when I do that, it's a very straightforward transaction. All that money that I've saved one way or another or earned or whatever that looks like, that $10,000, I take it out. I have cash. I give it to the golf cart person and they take my cash and I get the golf cart. But what happens to my $10,000? It's now gone from my life forever. Okay. Or if I wanted to buy that golf cart and not spend my own $10,000 cash right then, what could I do? I could go to the bank and I could get a loan. I could get a personal loan. I could get a collateralized loan for the golf cart, whatever the case is. What am I going to do if I get a loan from the bank, however? I'm going to have to pay interest, right? Banks don't just give away money. As a lot of you probably know, banks make money by lending money and then making a spread, right? So, and we could talk more about that, Craig, but at the end of the day, the bank's going to charge me interest. So I keep my $10,000 initially. I'm going to have to pay the bank back over time plus more. So that $10,000 golf cart is going to end up costing me maybe 12, 13, $14,000, depending on the terms of that loan. Well, cash sounds better there, right? That's $10,000, not 12, 13, 14. But is it really? Because if I give up my $10,000 cash, what am I really doing? Well, I'm losing the earning power of what that cash could have done for me if I was to take that cash and let's say invest it somewhere and earn interest off that money. Okay. So those are the options for most people: finance something or go buy it with cash. Well, what I decided to do was take one of my infinite banking policies and pull the $10,000 from one of those. Okay. Now, this is the foundation for all of this, and we're going to get into it. Okay. When you start an infinite banking policy, you're going to determine how much money you put into this thing. Okay. And then as you put money into it, you can borrow that money back out of it. So at the time, I had over $10,000 in that policy. So I borrowed the money out of that policy. Now, when I take the money out of that policy, what happens? Is it like my checking account at the bank where that money is now gone? No. This is the key to all of this. When I borrow the money from this infinite banking policy, my money actually remains in my policy. And all the money in this policy compounds and grows for the rest of your life. Now, when I borrow the money out of it, here's the kicker. I'm not actually taking my $10,000 from that policy. The insurance company is actually giving me money from their general account, and they're using the $10,000 in my policy as collateral to give me that loan. And that's what allows the $10,000 to remain in my infinite banking policy, compounding and growing at all times. So here's the cool thing about this. So now I have the $10,000 in my hand to go buy this golf cart. But like I just said, the money's still in that infinite banking policy, compounding and growing for me. So now instead of losing the earning power of that $10,000 or having to pay somebody else's bank interest to use that money, $10,000, now I have my $10,000 growing and compounding for me at all time. And I now own that golf cart. So I didn't lose the 10 grand and I have the golf cart. Now, what am I going to do from there? I'm going to be an honest banker, and we'll talk more about this, but I'm going to be what I call an honest banker. I'm going to start to pay myself back. So instead of paying the bank back, I'm going to pay myself back. Now, if I'm an honest banker, what do you guys think I'm going to say next? Well, when I borrow the money from someone else's bank, Wells Fargo, for example, do I have to pay them interest? Yes, we just talked about that. So if I borrow money from my bank, my infinite banking policy, my system, am I going to pay myself back with interest? Absolutely. So now that interest I was going to pay anyways, instead of it going to the bank's benefit, whose benefit is it going to go to? My banking system, which ultimately is my family's financial future. So just real simply put, that's really the foundation of this. We just find a better way. It's the same $10,000. We're just doing it in a way instead of losing the earning power or losing on interest, we've put it into a better vehicle to start with that allows us now to take advantage of all of that. Okay. But what are the key words right there? We have to put our money into a different vehicle up front to start this entire process. And Craig, this is where I wanted to ask you and bring you in here. When I put that money initially in the policy, am I going to have access to 100% of it?
You will not
Okay.
from the start.
Not 100%. And that's why we said, and we can get close to that, but not 100%. And I just want to make that very clear up front. Like everything we're doing this year, we want to be very transparent, be very upfront. Like there's no There's no like look in this hand or sleight of hand, anything like that. We're going to be very straightforward. So yes, so you're not going to have access to 100%. That's why we started up with you have to give up a little bit to get ahead, and why infinite banking rewards long-term thinkers. Does that make sense though?
It
So
does, and David just put a comment in there. Well, doesn't the interest actually go to the insurance company for the loan you took from the general account? And yes, David, there is interest going into the back to the insurance company. But when Stephen pays back his loan, let's say it was a 5% loan, Stephen's not really paying 5% back to the insurance company because it's a simple interest loan. He ends up paying something less. So now what we have to think about is just like a bank operates. You put money in a bank, they give you some small interest percentage, then they charge Stephen a bunch of money to borrow that money that you put in. So they're always looking at a spread, and the same thing we're doing is there is interest cost, but our growth, especially as we get the policy mature, that growth is going to far outweigh that interest cost. It
yeah,
won't necessarily be from day one, but that's why we're talking about long range thinking here. But
yeah,
you're
and David,
correct.
stick with us because we're going to show you this stuff using the BYOB vault, and what Craig is saying right now will show you visually exactly what that looks like. Because yes, some of the interest I'm paying back goes to the insurance company, okay, like you're saying, to their general account. But let's say that that's a 5% loan that I'm when I borrow the money from my policy, like Craig said, it's a simple interest loan, meaning each year the balance drops. So that 5% is on a smaller and smaller balance. So and you set your own terms. So let's just say I wanted to do a 5 year, I created my own 5 year terms on this loan. Well, over 5 years, I'm going to pay that back regularly. My effective rate on that will be probably closer to like 3.5% annually over that time. Now, if the bank was going to charge me 8%, the insurance carrier is getting 3.5%. What am I doing with that extra 4.5% spread? Well, that's that extra interest that I'm going to pay to my own banking system, going back to my own financial life, that instead of going to Wells Fargo or whoever, now comes back to me. So I'm making that spread just like a bank does. And the real kicker on top of that is like what I started with before. That $10,000 still in that policy is doing what that entire term, that entire 5 years. It's also in there growing and compounding through the insurance carrier's dividends. So not only am I only paying a much smaller rate and I'm paying myself back that spread, but my money's also in there over that entire time, growing and compounding within that policy. So that 10,000 might actually end up becoming 11 or 12,000, which also helps cover some of that 3.5% or so effective rate that we're paying on that loan. So I know that's a lot to say, and that's why I want to visually show it to you guys using the BYOB Vault here in a little while. But we wanted to set the stage and explain some of this stuff, get some of this initial things out of the way before we do show you this. Is that fair to say, Craig?
I think it's very fair. And the way I kind of look at it is there's intangible benefits as well. You mentioned it, but I want to just kind of stress it a little bit more is that interest that you're paying back to the insurance company is going back to their general fund. You're a mutual policy holder, which means indirectly because of the dividend, you're participating in the system, right? So that interest that Stephen paid back to the insurance company, indirectly, he's participating in that because he's a mutual policy owner, and that's ending up in dividends back in his policy, not those specific numbers, but contrast that with a stock-based company where the interest you may pay to a stock-based company, you're not participating in that, the shareholders are. So we have to think about when we're borrowing money, what type of system do we want to contribute to? Do we want to contribute to something we're part of, or do we want to contribute to something that shareholders are gaining from? So that's just another way to look at the interest.
Yeah, definitely. And one question I wanted to ask, the audience here is, have you ever put off something that you wanted to build something better financially? Like, have you ever done something similar to this before? It's like we're saying, if we're putting money in and we're not getting access to all of it, we're just delaying a little while that reward. So have you ever done that in your own lives? And I bring that up because we live in such a society these days where everybody wants everything right now. It's very hard to have patience. Like, you want stuff now, you want it done, you don't want to wait. There's this instant gratification that goes around. So I'm just curious if anybody's ever done that before in their lives already prior to this. I just was messing around on Zoom here with these poll questions. Let's see if that works.
you're getting fancy with the polling questions. You know what? I think about that instant gratification thing, and I think back to when I was a kid. The Wizard of Oz would come on one time a year, around Halloween. You have, Rudolph the Red-Nosed Reindeer that would come on one time a year. Well, it's not as special when you can just pull it up on demand. But I don't know, for anyone that was in that era, I tell you what, when those shows were coming on, you cleared your schedule, you sat down in front of that TV with the manual, channel, changer. But yeah, that was, we had to wait for that. We always had to wait for those shows to come on. But
Very cool. Okay, well, on this poll right now, we have 30 people participating, 31 people, 91%, 91% have put something off that they wanted to build something better financially. So it looks like we have people with the right mindset on here right now. About 10% are saying no now, 4 out of 41. So those of you that are participated, those 4 of you that said no, this might be a good time for you to learn something new and maybe try something differently. Because at the end of the day, we all have to ask ourselves, we just started 2026 right now this week, first week of 2026. So what did last year look for you? Did you achieve your goals personally, business, financially, specifically in this case, financially? Leading up to this over the last 10 years of your life, are you in a position today financially that you're happy with, that you're happy on the track that you're going? If no, then this might be perfect for you. Maybe try something a little bit differently. Maybe you're saddled in debt. Well, one of the top ways, in my opinion, to use infinite banking if you're in debt is to start the policy and follow the plan that we put in place for you. We have a strategy that's mathematically proven, and we'll show it to you up front before you ever make any decisions. We show it to you up front exactly what it's going to look like. But how would you like if you could pay off that debt faster, pay off that debt while still building wealth? Pay off that debt and have a bunch of additional benefits in the meantime while you're doing it. And that's exactly what infinite banking will do for you, allow you to pay it off faster while still building wealth and without losing all your money. And so, get that debt paid down. If you're in a position, if you said yes to the financial question, yes, I'm doing great. Yes, last year was awesome financially. Well, you're in the right place because you're right along with a lot of us right now, where we realize that if we can use our infinite banking policies, we don't need to pay off debt with it. We're using it as a warehouse of wealth. Our money's protected. It's guaranteed to grow. It's conservative in there. It's safe. And then when I use that money in opportunities, when I find a real estate deal, when I find a business deal, when I find an equity deal, something like that, I have the money. It's available right then. I pull it out and I can do what I want to grow wealth and take on the risk myself. And that's what this is all about. So if that's you, you're in the right place. And that was an interesting poll to see right there. So the final poll, 56 out of 62 people responding, 90% said yes, they put something off, and 10%, 6 out of 62 said they have not before. So pretty interesting, Craig.
awesome. Awesome. I just answered some of the questions in the Q&A. All right. So the poll, wow, 90% of the people have. I couldn't vote. It wouldn't let me vote, so I would have bumped up the numbers a little bit.
There you go. All right, cool. All right, so giving up something today to gain control forever. It's really like I guess, Craig, like a 3-step approach. So first off, you're going to want to think to yourselves, like, let me recognize the need. So we want to look at financial resilience. We want to think about control. Are we controlling our money? We want to think about legacy, right? Down the road. What does that look like for our family, for our loved ones, for important causes to us? When we talk about an infinite banking policy, yes, it is a specially designed and engineered whole life insurance policy. So it's life insurance. So what is that life insurance usually used for? Life insurance is typically used for what's called a death benefit, where if you pass away, a large sum of money is going to go to your loved ones, your beneficiaries, completely tax-free, as long as it's set up properly. And so that's why life insurance. So what we're doing is we're taking that same product, that same vehicle that has that same death benefit, we're just building it in a way where you could take full advantage of it, not only in your lifetime, but starting immediately within 30 days. You get the money in there, you can immediately start following the plan and strategy that we help design with you to start using that thing right away. But it's still building for that future, for that legacy. And if people ask us all, well, I don't have any kids. I don't really have anybody I want to leave a death benefit to. Well, do you have any important causes? I saw Tess on here earlier. Tess has told me this story many, many, many times before, where Tessa's like, "Hey, I don't have kids, but I have a lot of important causes. I have a lot of important family members, people that I do want to leave things to." And so that's why, to her, the death benefit is still very, very important to her, which I absolutely love. And Tess will be presenting and talking a little bit about that on our upcoming 3-day virtual training at the end of the month. But that's the first, just recognizing the need, Craig. And then number two, we need to then design that tool. And that tool, like I just mentioned, is that specially designed whole life insurance policy. And the cool thing about this is when I say specially designed whole life policy, I literally mean specially designed. Just like a snowflake, every single policy we design is unique and different. We, I've never seen two policies that were identical in numbers. Have you, Craig?
No, not unless they're the exact same person putting the exact same funding in at the exact same time. Other than
Right.
that, yeah,
And that doesn't
they're
happen.
all
We're all different
unique.
ages. We're all different health. We're all different financial positions. So I've never seen it. We've helped thousands and thousands of clients at this point. So every single policy is different and designed specifically for what your goals and needs are. And then once we kind of recognize what we're doing with this and why, and then we design that tool, then what's step three? Step three is to then use it. And that's what we're going to talk about. Paying off debt, financing major purchases like cars or golf carts, going on vacations, or building wealth, creating that legacy, creating that long-term thinking. And that's what it's all about. So just to give you a quick historical reference quote, I love quotes. JFK, he said, "We must use time as a tool, not as a crutch." And with that said, Craig, I know you have a really cool analogy you use using bamboo plants. And I don't know if we want to start sharing some slides at this point or
Yeah,
where we're at.
certainly. I'll share it out and just give me a second here. Yeah, so we've kind of talked about, Stephen covered the approach, but I don't know if anyone's heard of the parable of the bamboo, but if you haven't, you can of course Google it, but it was really about a farmer that was growing bamboo and he was sure this thing was going to grow, but if you know how bamboo grows, it takes a long time. It's almost 5 years underground, just kind of building out its root system. It seems like nothing's happening under the ground, but eventually, once it pops up, it just multiplies in terms of growth. So the whole concept of the parable of the bamboo is patience, faith, perseverance, and when we talk about building wealth and we talk about keeping and controlling wealth inside of this infinite banking concept process, it's very similar to the bamboo. You're going to start something, it's going to take some time to get that ball rolling. And I can tell you from experience, my oldest policy is going to be 17 years old this year, and it is a bamboo shoot. It just keeps going and going and going. So that's kind of the analogy we want to bring. I mean, everyone can think of other analogies of just, waiting for this plant to take off, but that's really what we want to talk about is how this bamboo tree just sits underground for 5 years and then, in 6 weeks it's tripled in size, and just keeps growing and growing and growing.
Yeah,
So
absolutely. And Craig, I know we mentioned our Nelson Nash earlier. I just want to show everybody this book real fast. This is kind of like I don't know, for lack of a better word, the Bible of infinite banking. It's like where it all started. This is what really brought infinite banking to the masses and has allowed us to grow and do everything we've been able to do with it. But if you don't have this book, definitely pick up a copy or listen to it on Audible. But really, really cool book. And Nelson Nash has just amazing way of thinking and looking at things. And I think we have some more stuff on him on the next slide too, right?
yeah, we do. So our Nelson Nash, on thinking, he made a big point of we have to think long range. And he felt that thinking was a lost art in today's world, and most people are not really using their thinker, they're reacting. And maybe we're putting too much into ChatGPT and letting ChatGPT make decisions for us. But our Nelson Nash really focused on that thinking, and not only thinking, but long range thinking. And we always want to look at what we're teaching here. We're not talking about a product. Yes, there are products that are part of this process, whether it's a specially designed whole life policy. We might have velocity banking aspects that come into this whole process for us. What we're talking about is a process of thinking of how money moves through a system. And so Nelson Nash came up with a few concepts I think we want to hang our hat on. One, which is our need for financing over a lifetime is greater than our need for life insurance protection. So we're going to buy cars, we're going to send our kids to college, we're going to buy houses. There's major purchases in all of our lives, and as Stephen mentioned earlier, we're either paying cash for those, so we made one payment, and then we've lost the opportunity to earn on that money again, or we're going to finance it and give up, interest to somebody else. So, those are some of the things that he would focus on, and the biggest one was really we want to control the banking function. And when you control that banking function, you win. So we want to start looking at how do banks operate? And that's all we really need to do is just take a step back and look at how does a bank operate? And then instead of doing what they tell us to do, let's do what they do. So that's all we're saying is quit doing what they tell us to do and just do what they do. And then we're thinking like a banker. We can start using this process. So, Stephen, anything you want to add on that?
No, yeah, no, it's just spot on, man. I'm just answering some questions over in the Q&A,
Okay.
and make sure if you guys do have any questions about any of this stuff, put that in the Q&A. We'll either respond right on there. We'll answer it live for you. The chat box seems to sometimes get busy, so keep those questions over in the Q&A. We'll get to some of those, but yeah, I mean, I think that's pretty good stuff right there, Craig. Just kind of the basics of some of this and what that looks like, and I think using some real world examples and case studies here will be a great way to demonstrate that.
Right. I skimmed over this, but I'm going to go back to it because it is a really important point that, Nelson Nash made. He said, if conventional wisdom was right, wouldn't everybody be financially independent? So think about all the things that we're taught to do. Think of all the things we're told to do. Think of all the ways we're told to do money. And that's the conventional wisdom. And the question is, if that was right, wouldn't we all be financially independent? But instead, when I look at, metrics around the debt to income ratios in America, the amount of debt the country has, the amount of debt that we have on our personal books, it kind of tells me that maybe the conventional wisdom wasn't right after all. And so we should probably be looking at something different. So anyway, let's move on to some cases. And I know there were some questions earlier in the Q&A asking about, how many policies can I have? What does this look like? How do I qualify? So when we're building a specially engineered and designed dividend whole life policy, there's a lot of things that go into the mix. So we look at your age. We need to understand your amount of gross income because there's going to be premium to income ratios that are applicable. So let's say, for example, you're making 100,000 a year. You can't put in 70,000 of premium. The insurance companies would say your premium to income ratio is way too high, not sustainable. This is not going to be a win for you, not going to be a win for anybody. So there's all these things that we do, and I call them ingredients. And it's no different than if you go down to the local baker and you want a cake, you're not going to tell them, well, I'd really like this much sugar, I'd like this many chocolate chips. And that's kind of how we work too, is we understand the problem you're trying to solve. Then we go build the policy, just like Steven said, they're almost like snowflakes. We're going to build a policy and a structure that works for you to solve that problem. Okay. There's different riders. That's what makes it specially designed is the riders that we use, how we configure those riders, and how we split that premium up to make it work for you. Now, with that, there's a few concepts I want to share. One of them is called human life value, and then we'll kind of cover the premium to income ratio and why do these things matter? What is this human life value? Why do these income to premium ratios even matter? The first thing I want to kind of just make clear is life insurance from the life insurance company's perspective, although there's a lot of them that do support infinite banking, they are all on board. I mean, they go to the Nelson Nash Institute, they support it. Um, but insurance, life insurance was simply a means to replace economic loss. So we have a person earning income, supporting a family. God forbid something happens to them. That death benefit is meant to replace their economic loss so the family can pay off the debts, the family can continue to live. And so that's really the whole purpose of life insurance. It just happens to be a really good tool to use for building our own personalized banking system. So then what we have to think about is how is the insurance company looking at this whole system? They say, all right, well, we're going to look at your human life value because that's going to determine your economic value, not how important you are as a human, but what are they willing to cover in an economic loss. And so let's just say, for example, you're 30 years old making $100,000. They assume that you have almost 30 years of working left. So let's say that you pass away and you've maxed out your human life value. They would let you go up to, say, 100,000 times 30. So let's say $3 million of life insurance. So those are some of the things that the life insurance companies are looking at. Those are ingredients and guidelines that we're using for design as well. So just think of it this way. The higher your income, the higher amount that needs to be replaced, the higher the amount needs to be replaced, the bigger the death benefit, the more we can put in premiums. So when people ask me, well, how much can I put in a policy? It's based on these guidelines. It's based on human life value. It's based on income to premium ratios. And it doesn't matter if that you could have five policies and not max out your human life value. You could have one policy that maxes out your human life value. So it's not really the number of policies. That's the restriction. It's the human life value and the premium to income ratios. All right. So let's do a quick example here. Person that's 50 years old with an annual gross income of 150,000. The insurance company is going to say, well, we think you've got about 20 more years of working. So then what they'll do is they'll take 20 times that 150 and say you can have up to $3 million of death benefit. Now, let's look at your gross income of 150. They'll say this is a guideline, so don't always use these numbers, but this is just kind of a guideline to say 25% of your gross income would be about 37, thousand dollars. That's the maximum amount of premium you could put in, but yet you have a death benefit of 3 million. So we may or may not consume all that death benefit. So as you think about human life value, it's really going to range based on your age group. So as we get closer to 65, 70, you might have a multiplier of five because you don't have that much more time of, from the insurance company's perspective, of earning income. You might be in retirement years at that point. So any questions on that, please put that into the Q&A box and Stephen and I can address that, or if it's something we need to address live, we're happy to do that as well. But just want everybody to kind of understand the basics of how those specially designed policies can be designed based on those criteria. Now, the first thing I'm going to say about policy designs, if you're just simply getting a policy design to get a policy design without understanding, or your money mentor or whoever you're working with hasn't really understood what you're trying to solve, then we don't really need to do a policy design yet. We're not going to do policy designs just to do policy designs. So if you were to come to us and say, hey, I've got debt and I want to look at my cash flow, I want to look at my debt balances, I want to look at the structure of those debts, will a policy help me be more efficient in paying off that debt and building wealth at the same time? That's what we do. Or you might come and say, you know what, I've got three kids. I have to someday put them through college. I want to use a policy to start capitalizing because I know I have some major purchases in the future. We can design policies around that. That would be a completely different design than I would do for a debt pay down. Or you might be looking at maybe you're in retirement, you have some different resources, and you want to position them just like on a chessboard. We're moving our pieces around to win. We may want to redo some of the cash flow, and we might build a policy that solves a problem for retirement. So if you walk away with nothing else, just think of policy designs always must be attached to the problem that we're solving or what you're trying to accomplish down the road. All right. We have a picture of what happens when you have the wrong policy design for what you're trying to accomplish. You might have a suit that doesn't fit so well. And this was actually, a Stephen, I don't know if this was, a suit that you used to wear in the past, but it's clearly something we need to get sized properly. So what we want to make sure we don't do is just get rubber stamp policy design. So if someone's just always doing a certain policy design, it's kind of a concern because you might end up in one of these great big suits that you can't even run. If this kid tried to run, what's going to happen? He's going to fall over. And that's the same thing with the wrong policy design. You try to move forward, you might just fall over. So design considerations. Think of these as some of the ingredients that we're putting into the the design of how we're going to build that policy. We're going to look at your human life value. We're going to look at your income to premium ratios. We're going to look at your age. Health does matter. And, if you do have some health situations going on, we can oftentimes run those through what we call preliminary underwriting just to see kind of how that may be looked upon from the insurance company's underwriters. And then we want to really get laser focused on the solution. Are you trying to solve debt? Are you trying to build opportunity funds? Are you trying to finance major purchases? Are you trying to do something completely different? So we really want to know what you're after, what you're trying to accomplish, because that will determine how we build out these policy designs. And then I've got, people come and say, well, you don't want to buy a vehicle in 3 years and it's going to be this much. Well, then what we can do is reverse engineer and say, okay, if you need 50,000 within 3 years, well, then we can figure out how much we need to put in either on an annual or monthly basis, or even do what's called a dump in. Stephen, do you want to explain dump-ins? Because we haven't even mentioned that word yet. And for the new folks, they may not even know what the heck's Craig talking about here. Do you want to cover that piece?
Yeah, absolutely. And it goes kind of to everything you were talking about with, human life value and premiums and whatnot, because, and somebody was asking also, Craig, just to incorporate this question into it also, somebody was asking in the Q&A, please address the policy premium costs and the face value of the policy for senior citizens, which may be very expensive for a workable infinite banking function. And you could be right. I mean, it depends on your financial situation. And so, like I said before, every single policy we design is different, depending on the individual. So when you schedule a call with us, and I put the link a couple times to schedule a call with our team, but our entire team that you're going to talk to, they are all Nelson Nash certified infinite banking practitioners. They've all been personally trained by Chris Naugle, myself, Craig, and our team. And they are literally the best of the best in the country for designing these specifically for your needs. And so, one of the first things we're going to have that conversation with you about is the premiums. What does that look like financially for you today and in the future? And when we talk about premiums, we're going to talk about a maximum premium you can put into a policy, as well as a minimum premium you can put into a policy on an annual basis. We're going to talk about, does it make sense for you to pay that premium once a year, twice a year, pay it monthly? And those are different options. The mode are different options, whatever fits your financial situation. And that can change over time as well. So this is very flexible. And when it comes to the dump in, that's where the flexibility of these is really, really, really cool. Because I'll give you an example. Let's just say that right now I'm comfortable saving or putting away, I don't know, $1,000 a month into a policy, $12,000 a year. Okay. Or maybe that's 6,000 a year, whatever the number is. Let's just use $12,000 a year. But I just had a really good 2025 and I got a really good year-end bonus. Okay. I got $50,000 bonus. However, I don't know if I'm going to continue to get that bonus every year moving forward. But again, I'm comfortable putting $1,000 a month into this policy. So what I'm comfortable committing to for the foreseeable future, for the next 5, 7, 10 years, is a maximum of $12,000 a year. But I got that $50,000 sitting in my savings account and I don't want to lose it. I want to get that money compounding and growing for me. So all a dump in is it allows us to put a larger lump sum of money into this policy the first year to jumpstart the thing. And the cool thing about a dump in is you're going to be able to borrow back out the large majority of it, typically over 90% of it, within 30 days. So I can stick that 50 grand in the policy. Now it's in there compounding and growing, guaranteed for the rest of my life tax free. And within 30 days, I can borrow back out 90% or so of that money to use for what I ever want to use it for. But I don't have to commit again to that 50,000 a year moving forward, because I decided my annual premium was going to be 12,000 max and about 4,000 minimum. So as long as I can do that each year, I'm good. And it allows me to get that big lump sum up there up front. And I'm just going to say, if there's any real estate investors on this call, when I do policies for real estate investors, one of my favorite policy designs for a real estate investor is $100,000 going into the policy up front and about $12 to $15,000 a year going into it after that for their first policy. It creates an incredible cash value very quickly. What Joe and our team like to call a money tree. It creates a very quickly. It creates a positive cash return very quickly. Just one of my personal favorites. But you can do whatever you want. And that's the cool thing is on that strategy call, we'll talk to you. Hey, do you have extra money you want to dump in? What does that premium look like and all of that. So the dump in, it's not required. It's not mandatory. You don't have to do a dump in. You can start with a few $100 a month if you want. But the dump in does give you that option of putting that larger amount in up front and getting it in there for you. So is that good, Craig?
Absolutely, yeah. So it's a flexible way of getting money into the policy quickly if you want to do that. And I was kind of thinking, Stephen, to your golf cart, you had $10,000, let's say, in your checking account, you're going to go buy the golf cart. That's a perfect case to say, well, why don't we dump that into your policy? And then let's say you're saving $500 a month anyway in your savings account. Well, let's make that the premium, dump in the 10,000, pull it out, and go buy your golf cart, and then just keep, running your $500 a month savings in and then structure a loan repayment. So that's one way it could be done.
Yeah, 100%.
Um, Now, with all of those ingredients, for those of you that may have heard of the MEC, stands for Modified Endowment Contract. It's the IRS guidelines on essentially, I'll just say it's you have to have a certain amount of death benefit based on the amount that you're funding the policy. That's a design consideration. We make sure that your policy will not be taxable. But if you put too much into the policy in a bad design with not enough death benefit, it can be taxable. We don't do those. So that's just another design consideration. So we're constantly balancing the premiums and how much go to the death benefit portion versus the cash side. Do we turn up the dials to get more cash value now that may come with higher term costs or more or less death benefits? So all of those are design considerations. And why I bring them up is just so you're aware of them, but that's what we do. That's what our team is experts at, is just figuring out all these dials and bells and whistles to get you the right policy. Now, what I want to do is walk everybody through a design, and this happens to be a policy with a $10,000 annual premium, no dump in. And what I'm going to do is actually go into our software we call the Vault. And I know some of you, just seeing your names here, I know that you're currently in the Vault. Think of the Vault as it's really the operating system for the infinite banking concept process. Manage your policies in here. You can manage your loans. You can manage your debt profiles. You can do velocity banking. There's a Chris AI component in here. So if you wanted access to ask Chris Naugle anything you wanted, what we've done is indexed all of the content we've taught for years, and it'll give you answers, and then it'll go right into videos. It'll take you to links into videos if you're trying to explore, say, how loans work. So it's a resource because we want to put power in your fingertips to help you manage your system, but we're also here to help you with that. Okay, so what does it look like to build a policy? And this is where this could be completely different based on what you're trying to do, your age group, the amount of money you're putting in, whether you're doing dump-ins or not. But the way we look at this is we have this thing called a cash value analysis. And what it is, a year by year illustration. It's coming from the insurance company, the illustration data, but they show you year over year over year, how much are you putting in premium? What are your guaranteed values of cash value and death benefit at the end of that year? Now let's talk about the guarantees, because although we're kind of planning on having dividends in the contract, these mutual insurance companies will guarantee you cash value growth. They will guarantee you death benefit. It will all be in the contract. Irregardless of what's happening in the market, this thing is going to continue to grow and just keep growing every day. So you'll see the guaranteed side, and then there's also a non-guaranteed side. And the difference there is the non-guaranteed side includes a dividend. The mutual insurance companies will share dividends with their mutual policy owners which is really, they take their profits minus expenses, mortality charges, death claims, all of these things. And at the end of the day, they have a pile of money that they spread out across their mutual policy holders. Now, here's a question, and I know there's plenty of people on this webinar that will answer this quickly, but in the last, let's say, 100 years of the mutual insurance companies that, and even the ones that we use, how many times in the last 100 years have they missed paying dividends to their mutual policy holders? So just put in your number. Do you think it's five? Do you think it's 10? Do you think it's zero? Do you think it's 100? So we have some nevers, some zeros. Steven, we got everyone on here. Oh, we got Paul here. He's saying 175 times. So,
Yeah.
for those people that said zero, you're correct. They haven't missed paying dividends. And so if we think about the last 150 years, Great Depression, Bank Holiday of 1933, world wars, we had even COVID in modern times. I mean, you look at all of the economic environments that these mutual companies have been through, and they've been paying dividends. Well, banks are failing. And earlier I saw Marius posted something about that these mutual companies do not operate off of fractional reserve systems. If you don't know what that means, go look it up, but it's how the banking system turns $1 into many. Insurance companies can't operate that way. So anyway, I digressed a little bit, but the dividend is going to be on the non-guaranteed side. Therefore, you'll have higher cash value numbers projected versus the guaranteed because they're looking at the dividend side. Now, I've had people tell me, well, my advisor said these mutual companies don't really ever pay the dividends. Well, that's easily refutable because they do pay them consistently. And the policy I've had for the last 17 years, every single year, I've had a dividend. So what we're going to look at is on a year by year basis, what are we putting in? How much cash value do we have access to? And then we measure just from an efficiency perspective. This is just the kind of some of the product tuning, if you will. But we'll look at a couple things. One's cash on cash. Stephen mentioned earlier, Joe on our team calls this the money tree. At what point in the policy's future will you put in premium? Let's say I put in $10,000 in year 4 and the policy grows 10,202. Am I now at a point where I have an efficient banking system where I'm putting in $1 and I'm getting more back? This is the point when we reach that money tree or that point where the bamboo, going back to the bamboo has now shot out of the ground and it's just going to get better and better and better every year. This is irregardless of what's going on in the market, everything else. I mean, this just keeps going and going and going. So that's one of the efficiencies. We also look at cumulatively, if in year 7 we've put in 70,000 and we now have 71,000 of cash value and we have a death benefit of 247. Here's a trick question, and I'm going to answer it the way Nelson Nash would answer because I know he has kind of a unique way of doing it. But if by year 7 I've put in 70,000 and I have 71,000 of cash value, how much did that $247,000 of death benefit cost me? Who can give me the answer? How much did that death benefit cost me? Deborah says 0. And does anybody know how Nelson Nash answered that question? There you go. We got the nuttons. Nuttin, he would say. It cost me nuttin. Anyway, it's kind of fun. So I can tell who's been listening to Nelson Nash. So anyway, that's just some of the things we look at inside of the policy structure. Now, I've got some people, and Stephen, I'm sure you run across them too, where they say, "Hey, I'm 65 now, 15 years later. I don't want to put this $2,500 in a premium. What are you talking about? I don't want to pay this. I don't want to pay this premium until I'm 80. What are my options here?" Well, if you look at this dividend column, it turns green about year 6. What that means is I now have a dividend big enough if I wanted to. I wouldn't necessarily do this, but it's good to know you can. You could use this dividend to pay for the base or the minimum portion of the policy, so you would never have to put another penny in it again. It's not going to grow as well because we're using the dividend to pay the cost of the policy versus reinvesting it, if you will. But when I get to be, say, down here at year 15, if I want to use some of that $5,972 of dividend to pay this 2,500, I can. Or if you have the 2,500, why not put it in? Because I put the 2,500 in, and because of all the previous years of growing, I now have growth of 9,330. Let's just keep doing it. So those are some of the things that you can look at in terms of policy design. Now, what I want to share with you is what would it look like? So we're just going to change it up a little bit. Same person, but now they have $25,000 bonus. They had a $25,000 bonus at the end of the year. They want to put that into the policy as a dump in, and they want to just plan to do another 10,000 on top of that every year. So remember, Stephen had mentioned when you do that dump in, you have a lot more accessibility to that or liquidity to that dump in. So if I put in 25,000, I now have 90% of that available within the first 30 days. One of the things this dump in did is it brought our efficiency point up a year. So in year 3, I put in the 10,000, I grew 10,322. So this is just a way to get more money in the policy quicker so that maybe I can pull it out to do my major purchase, or I can pull it out to do some debt consolidation, or I can put it in there in Steven's example with the real estate folks, put the money in there because they just sold a real estate deal, put it in there, 30 days later, pull it out and go do your next deal. So you'll see that policy design will vary those efficiency points. We can get them into even to year 2 with some designs. So by year 2, we have a money tree. We can bring that cumulative up too as well. Now, in some designs, we actually push those down because we're looking at building longer term capitalization, longer term funding, where these efficiency points don't matter as much because we don't need the cash right away. So just be cautious of always having the most efficient money tree. It may not be the thing you need to do if you're trying to capitalize and build, um, say, a policy for college funding for your kids and it's 15 years down the road. So that's where I just go back to everything relates back to solving the problem. Then we build the design that gets you that solution. All right. So let's go take a look at a couple things here. I'm going to go back into the slides. Stephen, any questions we need to hit on that policy design that we need to address live?
No questions. But do you mind if I share one more illustration? This
Yeah, let
just
me
to
just,
kind
I'll
of show
stop.
that, just to show that dump in one more time.
Yeah, I'll stop
Um,
sharing.
this is an example. If you've been around for a while, you've probably seen me show this before, but this was a policy I did for one of my clients a few years back. She was a younger, she was 40 years old. She is a real estate investor, and kind of to the example I used earlier, she had a good year. So she had $150,000 she wanted to put into the policy. So you can see that right there where it says contract premium year one, $150,000. So that's that money, going into that policy, year one. Let me see if I can draw. Yeah, so right there. Okay, and then you can see, all the stuff that Craig just showed, just to show you one more example of this. You can see the death benefit over here. And Craig, are you going to get into why the death benefit drops? I don't want to jump ahead.
No, go ahead and talk about it. I didn't cover that, but yeah, that's a good point to chat to share.
Oh, yeah, we get this question a lot, so I'll just hit it real fast. So you can see over on the death benefit column how the death benefit's always growing, 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 but then you can see in the eighth year how it drops before it starts growing again. And the reason for that is when we design these policies, we always design them to be as efficient as possible without what's called necking the policy. So we have to keep this a life insurance contract. We don't want it to become a modified endowment contract. And all that simply means is there's IRS rules and regulations around whole life insurance. And so what those rules and regulations basically say is as long as the policy acts as a life insurance contract, meaning you can only put in so much premium depending on how much death benefits in that policy. If you put in too much premium without enough death benefit, then it'll what's called neck the policy, and there could be tax consequences involved. It could lose some of its protections and things like that. So we never want that to happen. So when we build these policies for you, we build it right up to that neck limit. And sometimes what we need to do, especially when there's a dump in involved and a very high cash value involved, sometimes we need to add a little bit of term insurance to bump up that that death benefit to allow it to stay life insurance. Does that make sense? Okay, so that's what you see right there. We had to add 7 years of term insurance into this whole life policy to support it, to give us this real high cash value. But as soon as the term insurance is no longer needed because of the MEC rules, then we can drop the term insurance. We don't have to pay for it anymore. Okay. And so it goes back to, value is only an issue in the absence, or cost is only an issue in the absence of value. Where in this case, that term insurance is very valuable in those early years, so we need it on there, but we could drop it as soon as we no longer need it. So you can see that's where that drop is right there. When that term insurance comes off the policy, that's simply why that death benefit drops right there. Okay, but nonetheless, we get the death benefit on this thing. So 150,000 goes into this the first year, and then starting in the second year, she could put up to $50,000 a year into it. And then if she had like a down year, for example, in let's say the fifth year, she could actually drop this all the way down to like $17,000, $18,000. And then she can even make up for that in later years. So again, these are very flexible. Let me show you this example real fast. Let me turn this annotate off. Okay. So in her case, what we did with this policy, she wanted to use it for active real estate investing for the first several years. But then she wanted to become a private money lender. So I showed her, okay, so you're going to put the money in the policy each year. You're going to borrow the cash value back out, as you use this thing. So the first year she puts in 150, she can borrow back out 130,000. Second year, she puts in another 50. She can borrow back out of that 50, 47,000. Third year, 50 goes in. She can borrow back out over 50,000 starting in the third year of this policy. And right here in this column, you can see the cumulative amounts. All right, so that's what she was going to do. She was going to put money in, immediately borrow back out to put into real estate deals. But then she wanted to become a private money lender, okay? And so this is where this becomes pretty cool. So as a private money lender, she wanted to start looking at deals later on. All right, so in the eighth year of this thing, what happens? She puts in $48,000 in the eighth year. The policy grew by $66,000. So the eighth year of this policy, that's a 37% cash on cash return. Now, again, there's no risk here. This is all guaranteed growth or through the dividends. Okay. So she's putting the money in. So 37% growth in the eighth year. As soon as she puts 48 grand in, she could borrow back out 66,000. But here's the best part. What is she going to do with that 66,000 or 530,000 in cash value she has? Well, she's not going to borrow it back out and just waste it. She's going to keep doing real estate, but she's going to do what's called private money lending. Now, on a private money deal, a very common return is about 12% collateralized annualized return. So in the eighth year, she's going to put her money into the policy, pull it back out to use it. So she's going to make 12% on a private money deal. She's going to make 37% within her policy. Now she is paying, this is what was asked earlier, right? That 1 year, she is going to pay 5% interest to the insurance carrier. So let's do the math right there. So she made 12% plus 37. She paid 5% to use this money. So she's making 44% annual return on her money. Now, what's the alternative though? If she would have never started this policy 8 years prior, what would this look like? Well, her money each year would have been going into a savings account. It would have been being pulled out. Again, when you pull money out of a savings account, is there any benefit anymore? No, that money's gone. It's not growing any longer in a savings account. So she'd put the money in savings or business account. She'd pull it out to use it and keep doing that through the years. So the eighth year, she would have had the money, but she would have made 12% only on the private money deal. Instead, look what she made, 44%, because 8 years prior, she had the foresight to start this policy. So it goes back to what we originally opened with, right, Craig? Long-term thinking. So today, she put 150,000 in to have access to 132,000. So she gave up money in the early years to be able to get this kind of growth and returns in the later years. And if you look at this every year moving forward, it just gets better and better and better for the rest of her life. So really the question you just have to ask yourselves, what would you rather make, 12% or 44%? And we changed one thing, where that money went first 8 years prior. And it's as simple as that at the end of the day. So I just wanted to share that one kind of case use there, Craig.
Yeah, it's a true example of the bamboo shoot. Took 8 years to get that bamboo shoot growing, and then it just takes off. So,
It just gets better and better. If I showed you the
um,
rest of this illustration, as she gets into her 60s and 70s, and the plan we have for that of pulling the money out to use for retirement and generating retirement income. I mean, it all just the benefits start today, but the real benefits are in the future, and that's such a beautiful thing.
yeah, and Robert asked a question in the Q&A. I just wanted to answer that one live. So he's asking, well, what type of income do you need for that 150,000 premium? Now, we talked about human life value, which is how much death benefit you can actually have on your life. The one thing to know is in dump-ins, the dump-ins are not necessarily what the insurance company's looking at on premium to income ratios. They say, well, if you have 100,000 sitting in your bank account, well, yeah, that's fine. Dump it in one time.
Yeah.
But that ongoing 50,000 premium, that's what their income needs to qualify to put in. So Robert, in your question, I just want to separate those two things out because the dump in, as long as it keeps us underneath our total human life value, you can put that in. And then it's got to work with the premium. The premium has to work with our income. So I don't know what this person's income was, but it would have to be big enough to allow them to get 50,000 a year in.
Yeah, if I remember correctly, it was around 250 a year,
Yeah.
which easily allowed the 50 a year to fit into it. And
Yep.
again, she could have put, maybe a 300, $400,000 dump in. Even with that income, that would be perfectly okay and fine. But that's what she
Yeah.
had at the time was the 150.
Yeah. So, Stephen, I want to shift gears and just kind of show a use case on debt. And I'm
Love
going to
it.
jump into
Well, let's
the,
ask, does anybody have debt on here right now you'd like to pay
yeah,
down?
let's
Does
go through
anybody
that.
have credit card debt, any kind of bad debts, student loan debts, anything of that nature? Just put a yes in the chat box. We'll show you how to do this.
Did anybody spend more this Christmas than they thought they were going to?
I did.
Yeah. So,
And hey, Craig, actually, speaking of, I actually did just take a loan for my policy. I requested the loan Monday afternoon. I checked this morning, the money's in my account. So
wow.
2 days from request to the money being in my account, ready to be used.
Which you had some money that was seasoned, so that wasn't brand new money you put in, right?
Correct.
Yep. That's pretty wild. And so in two or 3 days, you got the money in there.
Yeah,
So
less than 48 hours.
yeah. So we have a lot of people that said yes and yes and yes and yes, which means maybe there are some that have debt and some that overspent on Christmas, some that don't. But what I want to do is just kind of walk you through, and if you go to the BYOBvault.com site on the front web page are some videos that kind of go through in more detail the whole debt structure, how you can use. But as we've talked about, these policies can be used to build wealth while you're getting rid of debt. They can be used to finance major purchases. They can be used for opportunity funds. So they can be used for so many things. But when we're talking to folks that are in debt, one of the first things we want to do is gather the information about, what your cash flow look like, what your income look like, what your expenses look like. And we also want to list out what these debts are. So you may have personal credit cards, you may have personal loans, medical debt, car loans, student loans, just whatever you have, we want to list that out and get the balances, the interest rates, and the payments. Now, once we have that, we'll be able to see, okay, what's the total amount of debt we're dealing with? What's the debt payments that we're dealing with? And then we can start to put a plan together. And I've worked with some folks that they're in a position where the debts are at the point where it's consuming their income. They don't have a lot of extra cash flow. So what we need to do is kind of work the system. We can't really start infinite banking yet. Maybe we can't even do velocity banking, but we need to free up cash flow. And so we'll structure the debts and figure out what's the best way to do that. And so what we typically look at is before we put any sort of infinite banking or velocity banking structures together, we say if you were to do no strategy on your debt, and what I mean by no strategy is a lot of times when I'm talking to folks, I say, well, when you pay that personal credit card off of $2,500, you were paying $75. What do you do with that $75? Well, I had expenses, I've got kids and, different sports. And so we just spend it. So once this debt's paid off, they'll just spend that money. And what we're trying to say is step one is let's get these debts organized in the proper order, the most efficient way to pay them down. It could be snowball, which is lowest balance to highest balance. It could be an avalanche approach, which is highest interest rate to lowest, or it could be cash flow index, which is looking at the debt balance divided by the payment comes up with an efficiency score. Those are three what I call sequencing methodologies. So instead of saying when the personal credit card is gone, I'm going to take that 75 and spend it. What we're going to do is we're going to take that 75 and add it onto the payment for the business credit card. Then when that's gone, we're going to take the 75 plus the 125 and add it to the 180. And we're just going to keep whittling these debts away until we get enough cash flow where we can put it into a policy or we can start some velocity banking. So those are the types of things that we work through in our strategy calls. But what I want to show is here's what it looks like if you don't have a strategy and you're just going to pay a debt off, take the money and run. In that $78,000 of debt that you have, you're going to pay another $30,000 in just interest. The bank is just fat and happy, and we need to stop doing this. So, step one is if we just use the sequencing of, say, the avalanche, instead of 181 months, we can get you out of debt in 80 months. We're not adding any more money. We're not introducing infinite banking. We're not introducing velocity banking. We've done nothing but just be disciplined in ordering those debts and paying them off and stacking those debt payments. 80 months, and then you knock that interest from 30 to 22. So let's say that you're in a situation where you have savings, maybe that's going into savings account, maybe you reorganize and you don't max fund your 401k, whatever it's going to be, you come up with some sort of strategy that you want to take some money and run it into an infinite banking policy. Well, what I want to do is show you earlier, we went through the efficiency points of a $10,000 policy where it was an annual policy. So what I'm going to do is we're going to structure this to say, well, we're going to take a loan once a year because we're going to fund this policy $10,000 every year. What would it look like if we fund the policy, take the maximum loan, throw it at the debt, keep funding our policy, take the loan, throw it at our debt? What does that look like? Well, here's what it looks like. Instead of having those debts out on our public record for 80 months, we can get rid of those debts in 46 months. So now there's a big step here. In 46 months, all of those debts that I had up here, these are all now gone. Every single one of them has been paid off in full. So we paid it off a lot faster. They're no longer on our credit report. They're no longer public because what we've done is you can think of it refinanced or we've moved those debts into the policy. So what we had remaining, we moved into the policy. Now we're in an environment that we are in control. We are going to take that same payment that we were paying to the visas and the student loans and the car payments. It was 1,265. We're going to continue paying that back to our policy for 31 months. So in 77 months, we've had all of our third-party debts paid off. Our policy loans are paid back in full. But here's what it looks like. You have $64,000 of cash value at that month 77. You have a death benefit of $247,000 at that month 77 in this particular policy design, in this particular situation. So let me just ask, would you rather do the no strategy, give away $30,000, have lint in your pocket at the end of the debt cycle? Would you rather just do the debt avalanche and have the debt's gone in 80 months and have lint in your pocket and you gave away about 22,000 of interest? Or would you rather implement the infinite banking policy, be disciplined, put your savings in there, and have $64,000 at the end of 77 months and a death benefit protecting your family of 247? So Tess is the only one I've seen so far that says skip the lint. But it's kind of a rhetorical question because, of course, who doesn't want to do this? But the important thing is, if you're in this situation, Stephen can put our link in there. You can get on a call with our team. We will gather your information. We'll put it in here. We'll run the numbers, and we can show you exactly what this would look like. And it's going to be a way to build wealth while we're getting out of debt. Now, the other thing that it gets into another level of strategy, if you've heard of velocity banking, if you haven't, there's great teachers out there like Christy Van. Matter of fact, we've got the Christy AI here. She teaches how you can use HELOCs or lines of credit to be more efficient with pay downs, so paying down debts. So what we would need to do there is gather your income sources, your expenses, and then if you have a velocity banking tool such as a HELOC or a line of credit, we can bring that together with infinite banking and show you, I'm just going to run a quick example, what it would look like if you did the debt avalanche plus infinite banking plus velocity banking. We call those three strategies, when you bring them together, we call that the debt blaster trifecta. It's frankly mathematically the fastest way to get rid of debt and to build wealth while you're getting out of debt. So when you look at stitching all that together in this particular example with that velocity banking profile, with that infinite banking profile, with that debt profile, we're talking about getting rid of those debts in 23 months. Now, we want to be an honest banker and pay back that HELOC. So we have 5 months of paying back the policy. We have a couple months of paying back the velocity banking tool or that HELOC that we used. But we're debt free in 30 months. Compare that to 181 months. Compare that to 80. So it's just frankly the fastest way to do it. Now, what does it look like in terms of at the end of that 30 months, we walk out, we have, I wouldn't say we walk away, we have $21,000 of cash value, we have $184,000 of death benefit. What we do is we move into that next phase of how do we build wealth with this 21,000, or how do we purchase our next car? So I
Hey,
see some.
Craig, real fast. Sorry, I'm gonna while you're finishing, while you keep talking here, I'm gonna launch a poll just asking everyone how they would use their first policy right now. Let's just say we're starting one right now today. I'm just curious. I put some of my favorite responses on there. If I missed how you're gonna use it, I apologize. But you guys participate in this poll. I'm curious. All right, keep going, Craig. Sorry.
Yep. So we've got about 5 minutes left, and I'm going to just show a quick snippet for all of you that are in the vault, or if you're considering the vault. The next piece we're putting into the vault is what's called the gain projector. That's where you may not be someone that has debt. You may not be somebody that wants to use your policy or your lines of credit for major purchases. So what would it look like if we showed you a model where you can take those resources, whether it's cash value, whether it's a line of credit, whether it's cash, to do an investment? And yeah, Alex, it could be to fund a business, and you're going to, that business is then going to start paying you back at some point. So this is not available for you. I'm just getting into one of our test sites, but we have this thing called Gain Projector coming. And what it's going to allow you to do is to pick your policy. So we'll have cash value available in our policy. And this one, let's say I'm at the point where I have 31,000 available, but maybe I only really need, you know, maybe I only need 20,000 for my investment. So I'm still going to have cash value sitting in my policy. That's great. Maybe I want to leverage a line of credit. Maybe I have some cash. So what it's doing is it's taking all these income sources and saying, all right, what's your investment? And I can define investments. I could define starting up a business. Maybe it's going to have some expected return at some point. But the whole idea is we want to show you year over year. And remember the bamboo. This is a perfect bamboo example because just like what Stephen was showing with the gal that he was helping with private lending. Well, in the first few years, she's giving something up, and we're giving something up in terms of our investment. But as we go through, by year three, we're positive, and we start to see, what did we put in cumulatively? What's our net benefit from our gains in the policy plus the gains in our investment? And we can just keep looking at it year over year. We get to year 10, we're at a 55% cumulative return. We put in 125. We have a net benefit of 193. So the whole point is what we're doing is we're going to build a tool that you will have available to you where you can model out your investment strategies, running money through your policy, running money through HELOCs, and just kind of pencil out how you want that to flow. And then there's some really cool visuals that you can get into and look at where it shows you year over year if you were using money from a line of credit or using money from cash, if you're using money from your policy. And it just kind of goes through that whole cycle of money comes from our policy, money comes from our lines of credit, goes into a segregated account. From our segregated account, we put it into our investment. So let's say we pulled 20,000 out of our policy as a loan, we put it into our segregated account. We then find an investment. Let's say we're going to do a private money club and we're putting $20,000 into that at 12%. It pays back $2,400 a year in gains. 1,000 of that's going to go back into our policy to cover the loan cost. We're going to take that 1,400 and in year two, stack it to the investment. So we're kind of building, there's different strategies out there, income snowball, but the whole idea is we're just stacking those gains to keep creating more and more gains that we keep running back under our system while our policy's growing. We're covering the loan cost, but we're taking the max loan every year and adding that to our gains from the previous year, and we just keep stacking this income. Now, at some point, you might say, well, I get to year seven and I don't want to invest anymore. I'm done. I want to I don't want to put any more, I don't want to take any more loans. I don't want to take any more money and ingest it. Maybe I start using that as income for retirement. So now this 82,525 is kicking off almost 10,000 a year. That could be supplemental retirement income. So the whole idea is we will have strategies, whether you're in debt, whether you're looking for major purchases, whether you're looking for investment strategies. We don't tell you what to invest in. We're just allowing you to have a tool that models how that money is going to flow through there. So that's what we're working on. That's what we've been putting together. We're really excited about what the vault's going to be able to do for everyone in the infinite banking and velocity banking communities because never before have you been able to blend those two things together, have you model this stuff out and just see, what makes most sense for you and your investment strategies. So with that, Stephen, any questions that we need to address? Anything we want to touch on before we wrap it up?
I just put the results of the quiz up. So, just asked how would you use your new BYOB policy? 52% of the people responding, there's 63 people responded. 52% would use it to pay off debt. So definitely debt out there, whether it's after the holidays or just been accumulating with the
Mhm.
rocket high inflation over the last 5, 6 years. So four people wanting to, 6% wanting to purchase major purchase like a vehicle. 21% people responding saying they'd like to invest, use the money to invest in something like real estate, which is what Private Money Club is for. And we're going to do a lot of education on how to do that at the end of the month. So keep your eye on your emails when we invite you to buy a ticket to our 3-day virtual BYOB Money School blueprint training. It's going to be really, really good. One person, I assume that's Shauna, said they're going to take a vacation with the money because I know she goes to Disney every year with hers. 5 people want to use it to start a business, which I think is awesome. And 7 people are like, let me just warehouse my money where it's going to compound. It'll be ready for the next opportunity, which is a lot of what I'm personally doing right now myself, that bottom one, waiting for the next opportunities because I do believe there'll be a lot of those in the coming year. So that's it. I just wanted to share those results. Pretty cool.
Awesome, awesome.
Let's see. I would like to set up a meeting if possible. Scenario that I feel this process would help us very significantly. Yeah, just schedule a call and we can definitely talk through that with you, Daniel. I'll put the link in again. So I don't see any other questions. I think we are getting to everything as we are going. Canadians can do this. Yeah, just send us an email. We'll connect you with our Canadian counterparts and get that taken care of. Put my email in.
Dex, I agree. We need to take more vacations. I see that in the comments.
Oh, it was not Shawnee, she said. So it's another, maybe you guys want a vacation together. Let's see. Bitcoin, Mark. Sure, you could buy Bitcoin. Dex said take more vacations. Love it. All right, cool. Well, I don't see any other questions. Can we add
One,
living benefit to the policy?
yep, one just popped in.
Yeah. Can we add a living benefit to the policy, Craig?
Yeah, so in a lot of cases, the living benefits, there's chronic illness riders, terminal illness riders. depending on your specific situation, sometimes those are just included. Essentially, the way those work is if you had, God forbid, if you had a chronic illness or a terminal illness prescribed, but the physician would have to write a letter. What the insurance company does, they crack open bigger chunks of that death benefit. So if you have to meet the criteria of those terminal illness conditions or those chronic illness. So, but those are included in many cases. So that would be one of the options for living benefits. And then the other way we look at the living benefit is the ability to use the cash value and have the policy growing while we still have that death benefit protection. We consider that a major living benefit because this is life insurance for, it has death benefit, but we're using it while we're alive to benefit us and our family. So I'd say all those are living benefits.
Yeah.
And let's see.
I love it, man. Chris said, thank you all. It's my fifth meeting, but it would help me that I stay tuned in more. Seriously, thank you guys, man. Yeah, Chris, that's what I was saying at the beginning. Like, our average client will attend our weekly webinars for around 2 to 3 months before they really are ready and kind of get it. And some people, it takes 2 to 3 years. Joe Kovacevic on our team, it took him many years before he realized what this does. It took me quite a bit of time before I realized exactly what IBC was. So keep hopping on the webinars, keep hopping on the trainings, keep watching the YouTube channel. And one of these days, somebody will say something and it'll just all of a sudden click. And guess what happens after that click happens in your mind? You can never go back to the old way of looking at how money flows and how money works once you understand how becoming your own bank truly does function. All right, Craig, any last words?
No, I just appreciate everyone showing up. I don't know how many we had. I thought at one point we said 140, 150 people, but appreciate you all showing up. And I can't stress enough, Stephen's point, it would just keep showing up because some of it might be kind of seem, repetitive, but that's how we sometimes learn. And then engage in the community, talk to other people that are in the chat box and ask questions and learn from each other. But that's why we do these things. We're all here to teach and learn together and just keep moving forward. So looking forward to 2026 and doing a lot more of these and just appreciate everyone being here today.
Yeah, absolutely, guys. And the YouTube channel, Bill's asking, it's youtube.com/ at the Chris Naugle. I can share that specific link over in the chat box for you as well. For everybody else, I will share another link that you can register for all of our free weekly webinars. So make sure you get registered. Once you register once, you should not have to register again each week. For a few of our shows, they are live streamed on YouTube and our Facebook channels. So you can join that YouTube channel. I just put right there, subscribe, so you never miss an event, or you can go friend myself, Stephen Nagy, or Chris Naugle on Facebook or Instagram. We typically stream on those as well. So go ahead and throw us a friend request, and those should pop up when we do those live streams. Otherwise, the rest of the stuff is on Zoom. So you register once for the Zoom event. It's the same time, same place, same link each and every single week. So there you go. I put all that over in the chat box. But again, we appreciate all of you being here, coming in from last year, 2025, being here to kick off the new year, 2026. With us. We appreciate all of you. Those of you that have been around the campfire, those of you that are brand new here, we look forward to working with you. Get your call scheduled with our BYOB Money Mentors. They're standing by, ready to go, ready to help you with whatever your situation is, whatever that poll answer was that you put out there. And stay tuned for more cool stuff to come. If anybody needs anything, reach out. We're here to help. But everyone have a great day, a great week, and we will see you next week on Wealth Webinar. Craig, thanks so much for your time today. Thank you, Tess, over in the chat box, Sean over in the chat box, and everybody else on our team that makes this go on each and every single day. We'll see you guys soon. Cheers. Happy New Year.